Good morning, friends. Welcome to weekly view on markets. Markets have corrected by more than 2.5% during this week. Escalation in Israel-Hamas war has impacted the global sentiments, and we have seen decline in all global markets. Technical charts are looking weak. Markets may see some more downside based on the other global markets movement in the short term. I have analyzed the DI and FII data, and DIIs are using every dip to buy more, and they are absorbing selling by the FIIs. So while traders needs to be cautious because there could be sharp declines based on the geopolitical developments globally, but investors should use this dip to buy good stocks with the investment horizon of 3 years. I am sure they will get very good returns. Let us look at performance of indices for this week. Nifty has closed at 19,047. It lost about 495 points, closed with a loss of 2.53% for the week. During the week, Nifty dropped below 19,000, but on Friday it has recovered and closed about 19,000 level. But charts are looking weak. Bank Nifty lost about 941 points, closed at 42,782, lost about 2.15%. Mid cap index lost more than 1,100 points, lost about 2.95%, closed at 38,701. Small cap index lost about 289 points, that is 2.23%, and closed at 12,639. India VIX is at 10.90, more or less stable at that level. Now let us look at sectoral performances. Almost all sectors have lost out. Media sector was down by more than 5%. Metal sector lost more than 3%, that is around 3.87%. Manufacturing, pharma and healthcare, consumer durables, private banks, information technology, commodities, realty sector, NBFCs all lost between 2 to 3%. There were no gainer during this week. Auto sector lost about 1.99%. Energy sector lost about 1.6%, and remaining all other sectors were in red. So this shows the turn in the market sentiment. The sentiment is very low due to the especially geopolitical global developments with respect to Israel and Hamas conflict. So let us look at technical charts. This is the daily chart of Nifty. The chart structure doesn't look quite good. On a daily chart, it has made a head and shoulder pattern, which is showing a kind of trend reversal in the short term. This is the left shoulder, this is the head, and this is the right shoulder. And during this week, it has broken the neckline. This line which has I have drawn is called the neckline. Nifty has broken the neckline, and this indicates that short-term sentiments are negative in the. This is the chart of Nifty Mid Cap Index daily chart. In this also, if we see the long-term support line of Nifty Mid Cap Index is broken, and Nifty Mid Cap Index has lost more than 1,100 points during this week. There could be some more downside to the Nifty Mid Cap Index. Unless it comes above this long term trend line, the sentiment for Nifty Mid Cap Index is negative. This is a chart of Nifty Small Cap Index. Here also we can see similarly the trend line, just like Mid Cap Index, the Small Cap Index long term trend line is also broken, and till Nifty Mid Cap Index recovers and comes above this trend line, that is around 13,000 levels, market sentiment in the short term is negative. We may see more downside in the Nifty Small Cap Index also. Traders needs to be very cautious, whereas these dips are good for the investors to accumulate good stocks. Now let us look at Bank Nifty. This is the daily chart of Bank Nifty Index. Bank Nifty Index also has made a kind of head and shoulder pattern indicating near-term weakness. This is the left side of the shoulder. This is the head, and this is the right side of the side of the shoulder. And I have drawn the neckline. Bank Nifty has closed below the neckline. During this week, it has broken the neckline and it has closed below the neckline. There could be more downside as indicated by the charts. All the charts are looking weak after sharp fall during this week. So it all depends on the geopolitical developments with respect to Israeli Hamas war and other global markets. Now let us look at some of the market fundamentals. RBI dollar reserves for this week has fallen by 2.36 billion US dollars, and the reserve position is 583.5 billions. About a month back, it was around 600 billions. From there, it had dropped to 583.5 billions at the end of this week. So, rupee is weakening. Rupee has crossed 83.20 level and now it is at 83.41. RBI must be supporting rupee against the dollar. They must be selling the dollars. That is why we see decline in RBI dollar reserves and rupee weakening. They are interconnected. Dollar index is quite steady at 106.58. So dollar index has moved from around 103 level to 106.58 in last three to 4 weeks time. So whenever there is a war-like situation, the globally demand for dollars goes up. Dollars is considered as reserve currency of the world. So whenever there is a war-like situation, the demand for gold and demand for dollars goes up. That is why we are seeing the weakness in rupee with respect to dollars. We are seeing the gold rate going up from 60,000 to 63,525 level in last 2 weeks. Crude price is at around $90.07 per barrel. So, war-like situation is having impact on dollar index. It has impact on RBI reserves. It has impact on rupee dollar rate. It has impact on gold prices and also the oil prices. FIIs have sold 13,186 crore, one of the highest selling in 1 week. And DIs have bought 11,552 crore in this week in equity. So FII selling is more or less being absorbed by DII buying. Why FIIs are selling? US bond yields is inching towards 5%. It is at 4.845, which is highest in last 20 years. So this rising US bond yield makes Fixed investment return in US in dollar terms very very attractive for FIIs. They are selling in all emerging markets, including India. So, and money is moving to US. That is why we are seeing strengthening of US dollars, the dollar index strengthening, and rupee weakening. These are all interconnected parameters. So we need to understand, being a market participant, we need to understand how these parameters move and how they are connected to geopolitical situation. If we understand these parameters, linkages, and its impact on the market, we are in a better position to take investment decisions in the Indian market. DIIs are using dips to buy in Indian markets because the macroeconomic parameters in India and also the corporate earnings growth in India are quite good. So DIIs are focused on Indian economy and Indian markets and Indian corporate earnings. That is why we see DII buying at every dip. Quarterly results declared so far for the second quarter are in line with street expectations, but there is no big surprise on the upside. So escalation in Israel-Hamas war, coupled with hike in gold rates, INR depreciation, reducing RBI reserves, all have negative impact on the near-term sentiments in the market. Quarterly results are quite good. They are meeting the street estimates. So my experience in past several years is that markets have always gone up higher after every crisis. So investors should stay invested and should not get worried about short-term volatility. In fact, this kind of short-term volatility based on global development gives a good opportunity for investors to invest more. Use dips to invest more, at least have a 3 years view, and I'm quite sure investors will get very good return. Indian economy is strong and uh, growth in Indian economy is good. Corporate earnings are good. Investments done during these times will give very good return in next 2 to 3 years. So this is all for this week. If you like my video, please subscribe to my channel. Share with your friends. You can ask your questions. We will meet again next week. Thank you.